Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday, everybody. Almost the weekend. I trust you've had a productive week and have a restful weekend ahead. We begin, as we usually do, with the economy. I know we've had a lot of coverage on the stock market this week. I also prefer to follow the actual economy at the macro level, but this week the stock market is one of the big stories we need to follow. Indeed, on Monday, when the State Council met in Beijing, the top of their agenda was the stock market, and as such, we continue to follow the story here. After days of increasingly desperate moves, the market seems to be finally reacting positively to Beijing's signals of support, for the time being at least. In trading yesterday, Thursday, the mainland and Hong Kong markets were up. In a telling sign of where the market expects the support to go, some central-owned SOEs, state-owned enterprises, did especially well, with 27 listed in Shanghai surging to their limit of 10% up. The Shanghai Composite Index rose by 3.03% on Thursday. We remember that leadership have been rolling out measures to shore up the stock market since Monday, when the CSI 300, the main China index in the mainland, dropped to a 5-year low. Indeed, recently the Hang Seng index in Hong Kong has fallen to levels not seen since the 1990s. Bob Prince, co-chief investment officer of Bridgewater Associates, said at the Asian Financial Forum this week that the company sees attractive prices for Chinese assets and is further deepening its investments in the Chinese market. He also addressed recent policy packages by Chinese regulators to prop up the market, expressing, quote, "China still has room for monetary and fiscal policies to help drive the economic recovery," end quote. Others are also cautiously optimistic. Charles Gave of the Hong Kong-based asset allocation consultancy Gavikel Research, in a note on Wednesday, told clients that China is set for a boom in corporate profits and, quote, "investors should be piling up shares of companies in sectors like healthcare, tourism, and luxury goods," end quote, adding, quote, "the Chinese stock market is undervalued against cash, Chinese bonds, gold, and other world stock markets, and it is in a state of total panic. It has to be the best value proposition in the world," end quote. Thus, some investors will be asking themselves, is now the time to buy? Deputy China Research Director at the same firm, Christopher Bedore, in a separate statement expressed, quote, "the stock market decline over the past year is clearly a judgment of the Chinese economy. Chinese stock markets tend to rally when nominal economic growth accelerates, and both Chinese and foreign investors have concluded that's not likely to happen for now," end quote. Other commentators argue that the situation now is much different than the last stock market crash and turnaround back in 2015. Alicia Garcia Guerrero, chief Asia-Pacific economist at Natixis SA, for example, observed this week, quote, "the situation is much harder than 2015. They need to come up with a big stimulus. I don't know whether they have the fiscal space or even if they can cut rates enough to make it happen. So brace yourself. We should tighten our seatbelts," end quote. In trading on Friday, today, the excitement already seemed to have fizzled out somewhat, with prices retreating across the board. The Hang Seng Index dropped 0.9% at the noon trading break. The Tech Index dropped 2.7%, while the Shanghai Composite Index weakened 0.4%. We'll have to follow this space closely in the coming weeks. But what do you think? Is now the time to buy? Would you even buy Chinese equities at all? Let me know your thoughts on this question in the comments below. In a Thursday press briefing, a deputy director of the National Financial Regulatory Administration vowed to boost lending support to developers, and yet another sign from high places that there is more support coming for China's crisis-ridden housing sector. The deputy director said that the priority is to help implement a financing mechanism and work with city governments to recommend property projects eligible for support to financial institutions. Chinese financial media outlet Caixin reported that earlier this month, the NAFR issued a joint notice with the Ministry of Housing and Urban Rural Development about establishing a coordinated financing mechanism for the property sector. According to it, regulators will shortlist qualified property projects based on developers' qualifications, credit record, and financial condition to institutions for targeted support. Quote, financial institutions should meet the responsible financing needs for development projects with sufficient collateral and a well-defined repayment source. Lenders should provide increased support to projects that temporarily encounter difficulties but can balance their books. End quote. This combined with an easing of rules for bank loans on commercial property from Beijing the day before boosted China's property shares, but analysts are lukewarm on how much they can do for the overall sector. As regular viewers know, China's property woes stem from deep structural issues. UBS analyst John Lam, in a note to clients on Thursday, touches on this very point, expressing, quote, while this could help to ease liquidity risk of indebted developers, property demand will need to be stronger for home prices and sales, and thus the sector to recover. End quote. This week's new measures included allowing developers to use the loans to repay existing loans and bonds, while raising the amount they can borrow to 70% of the appraised asset value from 50% earlier. We take note of these housing measures and move on. Finally, for part one on the economy, UK-based Carbon Brief has published a new report on China's clean energy contribution to GDP growth in 2023. The report claims that clean energy contributed a record $1.6 trillion to China's economy last year, quote, accounting for all of the growth in investment and a larger share of economic growth than any other sector, end quote. Clean energy investment rose 40% year on year to $890 billion, says the report, with, quote, the growth accounting for all of the investment growth across the Chinese economy in 2023, end quote. China's $890 billion investment in clean energy sectors is almost as large as total global investments in fossil fuel supply in 2023 and similar to the GDP of Switzerland or Turkey. The report argues, quote, without the growth from clean energy sectors, China's GDP would have missed the government's growth target of around 5%, rising only by 3% instead of 5.2%, end quote. On this topic, we note too that according to new official numbers published by the National Energy Administration on yesterday, new energy storage capacity in 2023 rose to 31.4 gigawatts from just 8.7 gigawatts in 2022, and almost quadrupling. The systems are mainly lithium-ion batteries. The tally also includes other technologies such as compressed air storage, but excludes pumped hydro facilities. US-based Bloomberg, reporting on the numbers, explains in a piece today that the battery storage boom comes as some provincial governments mandate renewables developers to build or rent capacity to ensure they capture as much energy as possible from intermittent wind and solar generation. China's new wind and solar installations probably accounted for well over half of the global total last year. With this news, economic analysts were quick to point out, however, that much of this growth likely came from state-directed investment redirected from the property sector, and as such was likely just looking for a destination rather than being attracted by promises of good returns based on strong fundamentals. We may be witnessing overinvestment simply being moved from one sector to another. Next up, we have one more story to cover. But just quickly, if you're enjoying today's episode, if you're getting some value from it, as always, I have a huge favor to ask. That is to like and subscribe. This is the best way to help the channel grow and be shown to new people. And for those who want to go the extra mile and help keep China Update financially sustainable, Patreon and Buy Me a Coffee links are in the description below. With your support, it means I do not have to rely primarily on corporate sponsorship, and I think that is best for the channel, and this is my commitment. Thank you so much, everybody, for the ongoing support. Next up, I wanted to look at an excellent Bloomberg report published this week with some very useful visual charts about the collapse in international travel from China since the pandemic, a state of affairs which is still nowhere near recovered and which is costing global tourism over $100 billion in lost revenue. To end today, we examine some of this report. We are now quoting selected excerpts from the piece directly. Chinese travelers, once the biggest spenders on overseas trips, have been staying close to home since the country reopened its borders 12 months ago from the COVID-19 pandemic. Outbound airline capacity from China stood at around 60% of 2019 levels during the fourth quarter. That's a much slower recovery than in the US or UK. something that has disappointed airline executives, tourism officials, and luxury store owners alike. Chinese travelers made 170 million trips outside of its borders in 2019, according to the China Outbound Tourism Research Institute. The $248 billion they lavished on items, from plane tickets to hotel rooms and designer brands, made up 14% of the globe's foreign travel spending. The Chinese pullback has erased $129 billion from global tourism. China's network of international airline routes has retreated by 43%. 45 foreign destinations are no longer served by direct flights at all. Many of the reasons for the drop-off are now well established. Lethargic economic growth has spurred Chinese consumers to choose less costly domestic vacations. Political friction has stalled the rebuilding of some tourism ties. Conflicts from Ukraine to Gaza have made flying long distance more complicated, while external destinations look less appealing to a safety-minded Chinese public. But the policy imperatives of President Xi Jinping are also at work. With the economy struggling, Chinese officials have prioritized local tourism over distant trips. There are 70% fewer routes to Taiwan than before the pandemic, with Chinese cities like Tianjin and Kunming no longer served. The political friction has slowed Taiwan's efforts to resume two-way group tours with mainland China. As a result, there is still no reciprocal agreement ahead of the travel-heavy Spring Festival. Despite lengthy historical ties, a shared border, and a growing aviation sector in both countries, there are no longer any direct passenger flights between the world's two most populous nations, India and China. Meanwhile, external factors have also hampered China's contact with the outside world. Carriers in the US, Canada, and the European Union, for example, can no longer traverse Russia, making flights with Asia longer, costlier, and less attractive. Prior to the pandemic, 17 Chinese cities were connected to 20 destinations in the United States and Canada through direct flights. The links have been cut in half on both sides, with Chicago, Montreal, and Saipan no longer served. In Europe, the trend is similar. More than a quarter of European cities that had non-stop flights to China now lack direct access, including Prague, Oslo, and Nice. The number of Chinese cities with air links to Europe has fallen by a similar proportion. Chinese travelers have, however, flocked back to the Middle East, an important plank in the One Belt, One Road initiative. Economic ties to the region, on the rise prior to the pandemic, have resumed swiftly. The Middle East and Africa landed about 22% of Chinese construction and investment deals for these infrastructure-led projects in the first half of 2023. Here ends the direct quote. Chinese authorities have taken some measures to try to stimulate external trips, generally, however, and Chinese visitors can also travel visa-free or with no-cost visas to a growing list of countries, like Malaysia, Thailand, and South Korea. The market appears to be slowly crawling back. By 2025, the World Travel and Tourism Council predicts China's outbound travel spending to rise to 21% above 2019 levels. By 2023, it's forecast to more than double from 2019 levels. These forecasts, of course, assume continued robust economic growth, not necessarily a safe assumption. So, we will have to see. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Friday. Have a restful weekend ahead. And I will see you all tomorrow.